Welcome to Tradiers, the Trader's Edge. I am Jim Urio. That is Bob Iacchino. And sometimes we will just laugh because we were just talking about something in the green room that probably can't be aired live on our podcast. DM us. Maybe we'll tell you what it was. This one was pretty good. But anyway, Bob, the stock market's up another 50 handles today. The move is relentless. The move is just continues to march on. What in the name of God is happening?
Well, I'll point to something I don't like about it. I mean, I think the 2 days of Jerome Powell's, I still call it Humphrey Hawkins.
Hawkins, right?
Now they call it the semi-annual testimony before Congress. The 2 days of it, he did nothing to dissuade rate cuts or to imply to the markets that there wouldn't be a rate cut. But I really do think when I look at this move, so we got 36 or 37, I think it's 37, new all-time highs in 2024 for the S&P, up 6 sessions in a row, 6 consecutive new all-time high closes, but declining volume through these last 6 sessions. Like almost every session except for 1 or 2 has been declining volume. And we all know about the market breadth and what's been going on there. So there's uneasiness and we keep making new highs. I think over the last 5 or 6 years, maybe 10 years, you and I have heard the phrase an unloved bull market just ad nauseum. This seems to be that.
I agree completely. For more on this, again, what we've said before a million times, you can think Bobby and I are full of shit, but you cannot deny that we get some top flight guests, and we will not disappoint again today. We are bringing in David Settle, co-founder of Market Scholars, technician, and one of our favorite guys to talk to. He is a prince. Let's bring in David. How tall are you, David? That's the first question.
Almost 6'6".
Almost 6'6". And what level did you play at? Did you play in college?
No.
You did. School. High school. And you still coach.
So I have a basketball question for you.
Bobby, I was teeing you up.
I think I have, what do we have here? Like 60 some odd years of basketball coaching experience right here.
I got 25. He's got as much, I bet. Yeah, right.
All right. So let's call it 50 plus years of basketball experience. I watched my first WNBA game ever the other day. And so I want to ask, obviously I'm going to ask you guys about Caitlin Clark, but I don't want to ask the usual questions, all right, about Caitlin Clark. I want to ask, am I nuts or does she actually play in a more exciting physical way? Like she almost looks, God, this sounds so bad when I say it out loud. She almost looks athletic. I know any one of those women could beat me 21-0. I understand that. And any one of those women could beat me at pretty much any sport. Okay. David, maybe bench press, and half of them could beat me on bench press.
Let me answer first, David, so you can measure your words so you don't get canceled. I don't care about getting canceled. Okay. I don't care. I've coached women's basketball for 15 years. I adore the game of women's basketball. I'm a huge fan of women's college softball. I watch it all the time. It's an interesting game. Watching women's basketball to me is difficult because basketball to me is a game about athleticism, and it's not the same game. Now, Caitlin Clark, for instance, she hits the home run ball. She shoots the long ball, which makes it very, very exciting. And I will watch her play. But you take her out of the equation and seeing women who David could dunk over every time down the floor back in the day. Like when John McEnroe said, well, Serena Williams couldn't beat the 500th person on the tour or whatever. That's quantifiable. I can go and show you 100-yard dash times from high school kids versus Olympians. Why do we want to put women in athletics with men mentally and compare them? Let's just enjoy Caitlin Clark's bombs. No.
Let me give David an out here because I'm actually not trying to compare men in women's sports or vice versa or any of that. I'm just trying to say, like you talked about, she shoots bombs. I mean, it's like pretty. As opposed to like the chest thrust shots that I'm used to seeing. Is she more athletic or is she just better coached or I don't know. What do you guys see?
She's highly skilled. She is highly, highly skilled. I mean, because obviously there are some NBA players that are very athletic that aren't as skilled. She is highly, highly skilled. She shoots the ball. She uses. She doesn't need a lot of strength to be able to shoot. She's very strong. She actually posted a video of her lifting weights just a couple of days ago. She's very strong, but
she's one of the ones that bench press me, is what you're saying.
She's like Steph Curry, right? Steph Curry uses his body when he shoots So it's not all up here. He uses his whole
every
body.
muscle's in sync. Exactly.
Yeah, so he can shoot from the logo, and so she does as well. And that's a skill. That's not necessarily athleticism. It's more of, thousands and thousands and tens of thousands of reps.
So do you think that she is going to single-handedly be the push the WNBA has been looking for, or is she Ronda Rousey from 8-10 years ago, whenever that was? Everyone thought everyone was going to watch women beat the crap out of each other because they're such a compelling athlete. Which one is she in your mind?
I think she's going to. You've already seen it, right? The views. Bob's seen his first WNBA game, right? I've been watching like the Fever play. I don't really watch any of the other games, but I watch the Fever because I want to see her skill. That's one of the reasons why I like the Warriors, because they were so skilled.
Move the ball so well. I love that about them. She moves the ball well, particularly in the open court. She sees the floor extremely well. I'd love
great
to
vision. Great vision. She's good with the ball. She's got good ball handling. She's very, very good. She's a very good player. I love watching her.
Nice. Let's just do the whole show on college basketball now.
Well, for anybody else watching, they lost me as soon as they got into the Warriors and all that. So they must have lost some of you as well. These two could go on all hour about basketball.
I will say one last thing about basketball. The Illini have amassed this unbelievable team in the offseason, and they're still not even in like the top 30 of the preseason polls. Literally, I think they're one of the highest paid college teams. And Coleman Hawkins, who left the Illini, is the highest paid college player at $2 million per year at K-State. So Illinois obviously has a big payroll, and they've stacked the team. You people now, here's the tip of the century. Bet the Illini to make it to either the Final 8 or the Final 4. Them being ranked 32nd is complete travesty. David,
I got
before we move on.
I got one last sort of sports-related question, because it's actually, I think, quite economic. They've just approved NIL payments to high school kids.
Oh,
yeah, in Florida. I don't know if it's everywhere, but it's for sure in Florida. And so I've actually had parents that I know personally call me and go, "Hey, one friend of mine has a son who's 6'6", and he's still kind of like his skill set hasn't grown into his body, but my God, this kid works." And he's starting to look more and more graceful. And he's only a sophomore going into junior year. I think he was 6'7" the last time.
Are you going to buy him?
What's that?
Are you going to buy him?
Yeah, I think they want 40 grand. I'll take them. No, so I'm just like curious if you guys think that's a good thing or a bad thing for the game. Let's forget everything else.
Dave,
my thought is, if money's being made, then and the players are the product, then if money's being made, then players should make some of that. Because they're the product.
But that's
nobody comes to watch.
That's not answering the question, though. That's not answering the question. Is it good for the game?
It definitely changes the game. I don't know if it will change it for the better. We'll see. But it will definitely change it. But the game has changed in a lot of different ways since in the last however many decades. And it just changes. Like, it's 90s basketball and 80s basketball was great for that time. It's a different game now than it was then. And it's great in different ways now than it was then.
And here's my answer to that too. And I 100% agree with David that I vote for this if it's put in front of me, because it is a sense of fairness. The people are making money. Why should they be making off their backs? I think it hurts the college game of football quite a bit. I think if you stack your team like Alabama, you roll through people. The game of basketball, I think it might add an interesting element to it. There'll be the high money teams, but then you'll get the teams like Murray State and Mercer and Belmont, teams that are basketball schools, Northern Iowa, teams that are basketball schools, but not like Kentucky basketball schools. And then once tournament time comes, it's going to be great David and Goliath stories, I think. Do you like that theory or no?
Yeah. Football. It's the same thing happened in the NFL. When free agency came, you started losing continuity, and the product suffered. I think the product suffered. I'm lived in Dallas. I grew up in Dallas, so I'm a Cowboys fan. But you had the Washington Redskins had the same team for years. The Giants had the same guys for years, and the product was great. And then free agency came, which it should be. There should be free agency, and there should be, they should get paid. But it definitely it changes the continuity of the teams, and the product suffers, and it has to evolve.
I agree with you completely. Yeah. All right. We sometimes on this show, occasionally we talk about markets and trading and finance. Let's do a crazy thing and branch over to that. You heard Bobby and I talk about the equity markets, and he mentioned the declining volume. first of all, just what the hell's going on? Because here's the way I thought this rally was going over the last 6 months. Excess liquidity from, COVID still in the system. The belief that the Fed's going to ride in on their white horse to save the day when the time comes, and anything related to AI doing the heavy lifting. The Fed hasn't come in yet, although we're still talking about it. AI doing the heavy lifting, but seems to be stretched. What now? What could carry us further? You got anything?
Well, it's just going to be these these large cap stocks. That's the AI fuel, and it is just a pulling forward, right? The market is pulling forward future returns. What it does, it pulls forward future returns. It's a pricing mechanism for what's going to happen here in the future. The Fed, it's interesting that the market views Fed as again, coming in on the white horse to save the day, because like rate cut cycles, falling yields have traditionally not been very good for the markets. Rising yields is actually what you want to see. In my opinion, if we want the markets to stay bullish the way they have been bullish in 2023 and 2024, we want the same thing to happen. We want rate cuts on the table, but we don't want rates to fall.
Interesting.
Right? We just want them on the table, but not to use them. Because once rates start falling, you can look at, I've got a chart here, and that's kind of why I'm looking at. When you look at all the periods of time where rates fall, and there's a caveat to that, because there's quite a few periods where rates fall, but it has to be during a period where when they started to fall, the yield curve was inverted. Because 1994 gets thrown out there a lot about soft landing, right? We're going to have a soft landing now like we did in 1994. The yield curve wasn't inverted at the end of 1994. So rates started to fall in 95, but the yield curve was never inverted until like 1998. 1999 is when it finally inverted. 2019 gets thrown around a little bit because we had a couple rate cuts. But again, we had a rate cut cycle, a mid-cycle adjustment. And rates fell during 2019, but the yield curve wasn't inverted at the beginning of 2019. It finally did invert late, but it wasn't inverted that. The yield curve is insanely inverted right now. So if yields start to fall like they've done every other time that the yield curve was inverted when they started to fall, that's not been a good thing. That's not going to save the markets.
Means the burning timbers are falling from the ceilings, Bobby.
Mm-hmm.
Yeah, David, I wanted to ask you, because we talk, obviously everybody talks about the magnificent seven, magnificent five, whatever you want to call them.
Mm-hmm.
What will it take for sort of an old narrative to prevail, or is that just never going to happen again? And I'll explain what I mean. I remember back in the day, a stock that was kind of near and dear to my heart, spending most of my life in Illinois, was Illinois Tool Works. It just went up.
Mm-hmm.
It just never did anything but go up. Even in the worst of times, it was one of the first stocks that people got back in on, because it was just tools. Right? It was just things we needed to recover and things we needed to continue in a good economy. And I look at Illinois Tool Works now, and the chart is awful. It's just like 4 consecutive months of lower lows, and it's down to an area where it hasn't really been on a consistent basis since like middle of 2023. How do we change, or do we change that narrative to where you can only buy tech, to where we go back and get into these sort of old reliable stocks where you could almost hide out?
Yeah, you can eventually. Eventually, you can get into those stocks, but only after the market corrects what's going on right now with this heavy concentration into, a heavy concentration into a few stocks like we're seeing right now is not a new thing. We've seen this a lot of times before historically. And that's what bear markets do. Like bear markets, the point of them is to fix that problem and get it to the point where you can start to buy some of these other companies that are a lot, that have a good value, and you shift towards them. But like at the end of a cycle, in a very late cycle, you have to stick with the guys where the market is concentrating until it's over. And it happened in 2000. It didn't happen in 2008, 2007, because we never did, we were still deconcentrating from 2000. We just had kind of like a second bear market in a small period of time. But we're having that again. We're more concentrated now than we were even in 2000 in terms of few stocks. So we just have to because I hear that a lot. I hear that we're going to get that rotation into and a broadening out. That's not how late cycles work. We don't broaden out. We narrow and we narrow and we narrow and we ride that train until it's just not there anymore. And we're in that cycle, and that cycle can last in the late 90s. It lasted multiple years. So who knows?
So will it be one of those things where, okay, there's a correction, a strong correction, people lose faith, they lose a lot of money in these high flyers, and then they decide to go back to more stable stocks? Or is it, and I mean, obviously I'm asking you to speculate here and sort of predict, so let's take that with a grain of salt. Or is it going to be that thing where everybody goes, finally a nice sell-off, AI is still the most important thing for the next 10 years. So I'm going to go ahead and get back in these magnificent.
Yeah, you saw that earlier this year when a little 5% decline, and look at the last 3 months, right? I mean, if you look at here, I have a chart up here, but you look at the last 3 months since that little 5% decline. Apple's up 38% in 3 months. Apple's up 38%. Nvidia's up 55%. Tesla's up 53%. Broadcom is up 32%. Qualcomm is up 22%. They just lose these little pullbacks. Even 2022, that big correction we had in 2022, what's been the biggest gainer since? It's been all these Magnificent Seven companies. I mean, every pullback will just be an opportunity to get back into these companies.
So what? Okay. This is, so you say we wait until it's over, because it's clearly not over, and I'm 100% with you on that. But what signals are we starting to look for? It's going to be a pattern of some sorts. Can you describe? I mean, I know there's a couple of different patterns that would suggest the end of days are near. A week or so ago, remember Nvidia made higher high and a higher low, closed on the beat low, traded down the next day below it. I thought, okay, perhaps this could be the start. It was not. What am I looking for at this point?
I think you're starting to see a lot of very similar scenarios now that you saw at the end of 2021, and a lot of very similar scenarios what you saw in 2007. The difference between 2021 and 2007 is, and this is kind of what threw everybody for a loop here, is at the end of 2021 we had this strong bullish market, Magnificent Seven FANG stocks were leading the way higher. And then you started to get a breakdown in breadth, which sounds very familiar. Started to get a breakdown in volumes and things. The correlation between the Russell 2000 and the S&P 500 went negative, and went pretty strongly negative. It started to really, really break down. And then obviously the markets dropped. But in 2021, when the thing started to drop, the interest rates were still at 0%. They hadn't started to raise rates yet by the time things started to drop. 0%, the Fed's balance sheet was still high. That's different now, obviously. Now the Fed is looking to cut rates very similar to the end of 2007, where again, the Russell 2000 was negatively correlated with the S&P 500. Breadth started to break down. Volume started to break down. One thing I noticed today, I think I tweeted it out before this started, was the correlation with MasterCard is breaking down. I look at that 10-week.
What correlation with MasterCard? What correlation?
The 10-week correlation between the S&P 500 and MasterCard.
Okay, yeah.
Right, kind of a longer term, almost a month correlation. Because I usually look at that 10-day, which is a 2-week, and then switch it up to a weekly chart. So that 10-week correlation between MasterCard and the S&P is now down to pretty darn negative levels. In fact, greater than 60% negative correlation, which, again, consumer economy, MasterCard, Visa should not be strongly negatively correlated. And the last 2 times that we were 60% or more negatively correlated was the end of 2021, the end of 2007.
So okay, 2 questions. One to make a point of what you said before about how rates coming down, stocks tend to do poorly. And I think, not to put words in your mouth, but historically, yield curve goes inverted. We sit there waiting for the recession. They wait a little too long, and all of a sudden, hell starts to break loose in some area. The stock market starts reflecting to that. At the same time, the Fed is jumping in to try to plug the dam. That's basically the scenario that's happened in the past, right?
Yeah. Excess speculation. Excess speculation eventually breaks.
Exactly. So tell me this: what are you do? Do you buy put protection? Do you hedge things? with your positions that have been working as well as they have?
Yeah, on a like not on an individual basis, because you'd have to buy individual puts on this stock and that stock and that stock. But if you kind of beta weight what you have towards like an ETF, like the SPYs, that you can then buy puts on that. But like and the VIX is really cheap, so they're going to be really, really cheap protection. Which is interesting though, that the VIX went up 3% today, and the S&P was up 1%.
Really weird. Yeah.
How often do you see a 1% move to the upside in the S&P and the VIX rallies, and not just rallies a little bit, but a pretty good rally.
Which then to me, because on big up days, I didn't today because I left early and was in front of my computer. But on big up days, I take some of that to hedge. Normally, I would just buy puts. Yesterday, I would have just bought puts. 3% move in the VIX. Maybe I buy put spreads that are kind of wide. Take advantage of hopefully a little bit of skew that's bumped out. Maybe get a little better price on those further out puts.
And skew has been really high. So there's a lot of people who have been doing that. Like the
skew good. I hadn't looked at it.
Earlier this week, the skew got above 150, which is a really high level for this. So that kind of shows that there is a lot of demand for deep out of the money puts for a reason, whatever that reason is. But there's a reason why they're pretty high in demand right now.
For the people who are watching real quick, and then I'll get Bobby the next question. We're talking about skew and puts. Well, there's put to call skew. We're talking about put skew, meaning that they're the further out ones, people tend to buy them just as like this insurance protection program. And they tend to trade a little higher than nearer puts based on the regular valuation models. I guess I didn't explain that very well, but just trust me that they trade a little better.
All because of 1987, right? 1987, the market broke. And so now those deep out of the money puts have value.
Which they shouldn't based on the model, but they do. Yeah.
We got a question from one of our regulars and a friend of mine down here in Southwest Florida, Tim, who asks, what is the catalyst for the market to pivot lower? Will it be geopolitics, or what do you think it'll be?
Well, initially it will just be correcting an overvaluation, right? It will eventually, just because that's what I mean, pullbacks, 5% pullbacks, 10% corrections or things. It will ultimately just pull back from a heavy value, from a strong overvaluation. Now eventually, because what I always tell people about like bear markets don't start from point A and then go to point B. Bear markets start as a pullback that fails, right? We fail to bounce up to new highs. Then that leads to the correction, generally down below the 200-day moving average, that also fails to bounce back up to new highs. And then a break, usually below the 200-week, is when like you're now in bear market mode. So there's multiple stages of drops and failures. So even like 2007, when we pivoted lower at the end of the year into early 2008, it didn't start off like that's when it started, but everybody associates the bear market of 2008 with like September and October. But that was like the washout. I mean, we had already been in the bear market. We had already pivoted to the downside. It just failed to bounce. And so ultimately, when we get the drop of, a pullback, when that pullback fails to go to new highs, that is a huge red flag and a sign that we will ultimately pivot more to the downside. So you see that like in early 2022, we dropped like 9% without a bounce. And when we did get the bounce, it failed to go back up to new highs. We saw at the end of 2018, a drop of almost like 10%. It failed. So there will be a normal decline that will probably get closer to 8, 9, 10%. When you see that without like a 5% jump, when you see that happening, then we're starting to pivot. If it drops 5%, 4%, 3%, and then bounces right back up to new highs, keep riding that train as long as that train lasts, because we know that train can keep going for a long time. But when it starts to drop, when that first pullback dips down to 8, 9, 10%, then there's a good chance that the next bounce will fail to get to new highs. And when it does, forms a lower high point, then it's on. Then it's game on for like correction mode, break of the 200-day moving average, and then however long it trades below that. But I mean, that's not going to happen tomorrow. It's not going to happen next week or next month. It could happen by the end of we could be in that stage by the end of the year. I think there's a good chance, actually, we are in that stage by the end of the year. But it will start first with a normal pullback that everybody else will be talking about. This is very normal. The market's pulled back 5, 6, 7%. We'll just buy this dip. and then you buy the dip, but it doesn't get up to new highs, and there's your sign.
All right, I actually have a real question, but something you just said struck me. Do you think that will then be a sort of be careful what you wish for Fed rate cut scenario? In other words, yeah, everybody thinks like, oh, this Fed rate cut's going to be great for the market, but like 4 or 5 is not great for the market, right? Because that means something's wrong.
Falling yields is not good for stocks unless the yield curve is not inverted, but that's not the case. It's inverted to a very large degree right now. So falling yield is not good for stocks.
All right, let's go to my actual question. So we kind of start earnings tomorrow morning, right? We got Pepsi and Delta, and I think we have Manchester United today, which is kind of fun. But Friday, we get some of the big banks. So according to FactSet, S&P 500 financials are expected to report the largest decline in earnings in quite some time. So I'm going to read you something right here. The financial sector is predicted to report the 7th highest year-over-year earnings growth rate of all 11 sectors for the second quarter of 2024 at 4.3%. At the industry level, 3 of those 5 industry sectors are expected to report year-over-year growth. So if banks are supposed to have a very large decline in earnings but still show growth, is that enough to kind of trigger it, or is the banking sector not what it used to be in terms of, well, banks can go lower, but the Magnificent Seven will still be enough to pull the market higher?
Yeah, I think it could trigger a little bit of a pullback in the broader market, a little pullback. But until you start to see those Mag 7 stocks break down, it could be financials. It could be, you were talking about industrials earlier. We talked about MasterCard. MasterCard's been in a decline for how many months now? A few months here. And that's a consumer stock, at least a representative of consumers. And like none of that really matters. Like the Russell 2000 has been flat. The Dow hasn't been rising. Dow Transports has not been doing very well. But it doesn't really matter until you start to see a breakdown in Apple's earnings, Microsoft's earnings, NVIDIA's earnings. That's going to be the big catalyst.
So something you said before, I want to put a bow on, because Bobby said something. Does something have to happen? And we both were thinking from a macroeconomic standpoint. It sounds to me from your answer that you believe something that I've been kicking around for a long time. The same exact headline can have wildly different market effects based on positioning. You know what I mean? So even like back in February and early March of 2020, obviously the economic headline was enormous. We were going to shut down the whole world, but there was, positive side to it too. We were expecting the Fed to come in and flood the market with free money, and they did until March 23rd. And we corrected 36%. And the 36%, fueled by Bill Ackman. But in different, is there another scenario, perhaps, if everyone wasn't so bulled up, maybe the stock market had been in a channel, that we get all those same headlines, the stock market doesn't really move, so the headlines don't even matter that much? Is that making sense?
Yeah, I definitely agree. That, you've seen, like, you guys know the Citigroup Economic Surprise Index, which looks at, how for those who don't know, it looks at how the actual result of an economic indicator compares to the estimates, and then looks at a rolling window of time and kind of measures that. Right now, it's very negative. It's very negative, which means over the last 30 days or so, most the ones that produce the most volatility for the dollar, they have come in well below expectations. So pretty negative headlines, and we're still just trudging higher. Like the market just doesn't. But there will come a time where it does care, as we saw in 2022, because in late 2021 it also got very negative despite all-time highs in the S&P. So there will come a time where, again, we get that pullback and it fails. But as of right now, I think actually this earnings season will help us continue to push up beyond, and we'll overlook some of the weaker ones and focus more on a select few.
Okay, so tell me this: we talked about tech, and everyone talks about tech in tedium. I personally think that when stocks start to do poorly because the Fed is forced to lower rates, that things like gold, silver, as easier money could do quite well. Have you done any work on those commodity sectors or not?
Not so much, but long-term bonds do very well, obviously. Whenever the Fed's cutting rates, bonds start to do well. Bonds are extremely oversold. Like they are very, very, very good value right now relative to equities. Very good value. So it's one thing for bonds to be down because stocks are rising, but bonds are extreme. I mean, the Fed raised rates from 0 to 5.25%. We had this tremendous run in the 10-year, and it's pushed long-term bonds down to very, very low levels, with stocks at obviously very high valuations. And so I think at some point in time, bonds are going to be insanely attractive.
So you're talking 10-year, right?
Mm-hmm,
and where do you think that that yields on the 10-year could go to? Do you think they could go back to 3.5? Is what you're saying?
Probably, yeah, down to 3.5. I don't think they'll go back to 1.5, right? I don't think we're ever going back to those levels, but definitely down to like a floor of 3.5%, 3%.
Interesting, because I'm on the other side of that, because I think the issuance that's going out the curve might make people more reluctant, but I haven't done any of the technical work on it, so I defer to you. Robert?
Yeah, actually, I was just sitting here not listening to either one of you because I wanted to send Ringo in the background the economic surprise index. I grabbed the chart off of Macrovar just to credit them ahead of time before he's able to put it up. And then I also wanted to put up deficits as a percent of GDP, because one of the things I want to talk about a little bit is the election. So Ringo, one of those pictures is titled deficits, and the other one was like screenshot XYZ123. I didn't have time to name it. So if you could put up first the one called deficits, there is a lot of media out there talking about how inflationary Trump is going to be. By the way, at the same time, I saw an FBI report today saying that Russia is trying to skew the election in Trump's favor, according to intelligence officials. I'm like, come on, we've seen this movie, guys. Don't do Ghostbusters 2. Don't do it. We've already seen this. Just stop. But anyway, this deficits thing I thought was interesting because they're talking about Trump being inflationary. And I think both of them are inflationary. So to Jimmy's point about the spending, okay, I think the economy is slowing, but is still strong. All right. So here's the deficit projections. President Trump never had a budget deficit over 5% of GDP, meaning the deficit part as a percent of GDP. His highest was 4.6 until COVID. Biden, 2021, we could call that still COVID if we want. And I'm not going to argue with somebody if somebody says that's still COVID. But he's never had one under 5%, and the OMB is not predicting one under 5% under President Biden as far as they're willing to predict. This is from our friend Mike Singleton at Invictus Research, who allows us, very graciously allows us to use his charts on shows like this. So this in and of itself is inflationary. You want to talk about Chinese trade war with Trump, whatever. This kind of spending in and of itself is inflationary, right? If we get a situation where you have a Trump presidency or a continued Biden presidency, which seems like it's being one or the other, we have inflation coming from the fiscal side, in my opinion. So if you get a situation where we get weakness and the Fed cuts, does that mean it's quickly recoverable in your view or no? And then I'll have Ringo put up the Citibank surprise.
And that's the thing is like you can have, a large deficit and not be inflationary as long as real GDP grows at a very high clip, which is basically what we had in the late 90s. And I think that is the idea with this new AI craze is that, this is going to be just like the internet was in the mid 90s to late 90s, where we get this strong real GDP growth, which kind of tempers the inflationary components of this fiscal policies. And the other way that you can limit inflation with strong, with a larger money supply and big fiscal spending is that the money velocity stays pretty negative. So that money does not change hands, which we've had very high levels of money velocity over the last year or so. Money exchanging hands left and right. Everybody's spending money, but when that comes back down, kind of to your point there, when velocity comes down, which I think it is, that's very recession. Obviously, when people stop exchanging those dollars, that tends to be very recessionary. And with lower, I don't think real GDP is going to be very strong. And so when you have velocity money dropping from what is pretty much an already pretty low level, but it's forming a peak and rolling back over, and then you have real GDP dropping. I think real GDP will be dropping by what already is expected to drop here on this next quarter, but throughout the rest of the year. Then combined with this higher fiscal spending, which keeps that money supply pretty strong, then that will keep inflation levels pretty high. That's, again, that's what brings that inflation level back up again, and that's ultimately that may be what that gets the Fed to raise rates ultimately again, but at least gets them to stop cutting rates or even thinking about cutting rates here. And after a few, that I think we're going to get one or two, because I think if they don't cut rates, that would be by the end of this year, after starting the year with a forecast of 3 cuts, to not end the year with any cuts, I think would be, from their perspective, very bad for credibility. So I think they're going to cut rates regardless, at least once, just to say that they did by the end of the year. This kind of like how they raised rates at the end of 2015, just that one time. They didn't do it again at the end of 2016, just to say that they did, right, from a credibility standpoint. But what probably would limit them from continuing to cut rates into 2024 or 2025 and beyond would be this scenario here.
So this is what puts me more on Jimmy's side of the bond conversation, but the economic surprise index, with which, Ringo, if you could, is what puts me on your side of the bond debate, because I actually, the reason that I was able to find this so quickly and send it over to hopefully get Ringo. Are you back there, or is Luger back there? You
no, I love when you talk slow, waiting for your chart to come up.
I know. Right? I looked at this the other day, oddly enough, which I don't look at this that often, and it is just like, I mean, it's trending lower, period.
Yeah.
Right? There's just no other way to look at this. Yes, we've turned up a little bit over the last couple of days, and each point is a day, Jimmy, if you've never looked at this.
No, I haven't. Yeah.
There's always data, right? So they just kind of track this thing on a daily basis. So I don't have that big of a data set here, but it has just been weak, just weaker and weaker and weaker. Mm-hmm. So, and David, correct me if I'm wrong. What this basically means is that the economic data surprises negatively.
Mm-hmm. Yeah, they come in below estimate.
Retail sales was shit. Sorry, David. Retail sales was shit. The jobs number was shit. Masquerading as a good number, but the market didn't believe it. Yields went lower right away. I mean, I think the numbers have been terrible. I think the notion we may have a soft landing, but we don't know. The plane's still 20 yards off the ground. Well, let's hope for a soft landing, but I don't know. What do you think, David?
Yeah, I don't think we're landing. I mean, we're definitely not landing yet until the yield curve starts to rise. Like when the yield curve is rising, like going through zero and back up, that's the landing, right? We're still flying. Like we're still negative. The yield curve, if we can stay inverted on the yield curve for another year or two, the markets would love that. We'd have another 20% gain this year. We'd have another 20% gain next year, as long as it stays inverted. Once it starts to rise, that's your landing. And since it's going to be rising from a deep negative level, that's not. I mean, there's no. It'd be very low probability for there to be a soft landing associated with that.
Good. And I have a steep and around, by the way, which is widely publicized. I've made some money at it, but not very much. I have a steep and around because I do believe the plane is going to make contact with the ground, and I'm not sure it's going to be the landing that people think it is. Can we pivot? Well, Bobby, unless you want to talk more about this chart.
No, I'm good. I'm good.
So of the Mag 7, NVIDIA, I'm not making any recommendations. Lawyers, these guys can. They're licensed for that. NVIDIA seems stretched. You can't really put on a buy recommendation on NVIDIA right now, can you? And what is something that could play catch up?
And which way do you say it?
Broadcom would be one that could play catch up. I mean, it's the same thing that happened in NVIDIA. NVIDIA made a run off of those 2023 lows where we had the regional banking crisis. The market had a little bit of a pullback in March 2023. NVIDIA has taken off from that point. At that point, NVIDIA's market cap was well past. It's more than doubled from that point. But for it to double again, which I think a lot of people think, hey, it's doubled in the past year plus, it will double again. Well, for it to double again, it would have to go from a $3 trillion market cap to a $6 trillion market cap in a year. And considering Apple and Microsoft are at $3 trillion, that is going to be very unlikely to happen. It can catch up, but it's going to be very hard for it to extend so far beyond where Microsoft and Apple is. So you have to look for others that are kind of in that, where NVIDIA was last year, where it can make a catch-up trade up to where now the leaders are. And so like Broadcom would be one of those. Tesla, obviously, I think it started, obviously 55% over the last 3 months, it's been very low. So you have some opportunity there for catch-up in this market cap. But I wouldn't bank on NVIDIA doing like, say, a 50% return from today, or especially 100% return from today, because of the implications of what that would mean from a market cap standpoint. It's to go from 2 to 3 is a big deal for everybody else but NVIDIA. So now NVIDIA is in that camp. So for it to go from 3 to 6 would take, obviously would mean Apple and Microsoft probably would have to do something similar too. And it's again, unlikely for that to happen. But for Broadcom to get closer to 2 trillion, that's a trade you can make. And as it makes catch up, and anything else, Qualcomm, Adobe, some of these AMD, another chip stock that's in that kind of that space, for it to play catch up, those are better trades right now than trying to get another 100% gain out of NVIDIA in the next year.
So I like ASML. Do you have any sort of feeling on that? And that's a Tim McLean conversation too. We were talking about that a couple of shows ago. And Tim was the one who pointed out to us that, if you just look at sort of like their profile, and I'm just reading this from Yahoo Finance, market sells and services advanced semiconductor equipment systems for chip makers. And the reason I say I like them is because I look at an NVIDIA, by the way, which way do you say it? NVIDIA or NVIDIA? You say NVIDIA? Okay. It's sort of like nuclear and nuclear, or jewelry and jewelry. I like ASML because I think I look at an NVIDIA chart and
Did you just knock your microphone over?
Yeah.
Your new $500 piece of equipment, you just knocked it over?
Yeah, the stand comes Saturday, so I got it balanced in between 2 pool balls. But it's a trick, right? So, but I'm looking at it from a perspective of I look at the NVIDIA chart and I'm like, where can I buy this? Like, it has to dip to a level as like a chart first guy that I don't think it's going to dip to. And just by virtue of the fact that I said I don't think it's going to dip there, I should probably buy it, but I can't get the risk reward correct. This is not able to do it. So how do you feel about ASML, if you feel anything at all?
I think you have to have some exposure to Apple, Microsoft, NVIDIA. You have to have some of your longer term portfolio, which I would venture to guess 95+% of people do have some exposure through the index funds and things like that. So that's great. So people who think maybe I don't have NVIDIA, you do. You already have NVIDIA. You have a good chunk of NVIDIA already in your portfolio, along with, in fact, if you have an index fund like the S&P, then 20% of your portfolio is Apple, Microsoft, and NVIDIA, or 21%.
Fair enough.
Right? So you've got exposure to it. So I do like the idea of derivative plays, like you're talking about there with ASML, that have, that are kind of indirect plays on NVIDIA, are great opportunities for trades, right? Whether I don't think they would be like a good long-term investment, but definitely a good trade that you can be able to ride any existing trend on for as long as that trend lasts. To be able to get something in addition to what you're getting from your longer term portfolio, which is heavy into these bigger names that, like I said, you do have. I mean, 3 of those stocks is 20%. I think the whole Mag 7 complex is like 30 some odd percent. So I mean, a third of your portfolio is in these names. So you don't have to worry about making additional trades on those names to try to get some extra alpha.
That's a great point. What percentage of the NASDAQ? Do you have that offhand too?
I know that Mag 7 as a whole is over 50% of the NASDAQ 100. NASDAQ 100.
Why have the other 100 in there?
You think I don't have enough, and then you see that you do have enough, like you said.
Got plenty. Yeah. Assuming that you have your longer term portfolios in kind of U.S. index based large cap funds, which I would venture to guess the majority of people do.
That brings up something that I want to talk about really quickly too, is the passive bid. Because we just kind of flirted around that, saying that people own it without even knowing they own it, because you just are buying it every month, these passive bids. Do you think that can sometimes represent a misallocation and could fuel the FOMO trade that makes the whole thing even worse than it could have been in the past with bubble creation. And by the way, I don't even think this is a bubble necessarily, because for a bubble, I think I need to see people margining the shit out of their account to buy tech stock. And I'm not seeing that. I'm not seeing it in real estate. So I'm not saying it is. But the passive investing bid, do you think that could really obfuscate price to a significant amount and cause greater pullbacks than would normally happen? Crashes, perhaps?
Well, eventually, yeah, eventually. I mean, I wouldn't say the greater pullbacks, like your typical 5% decline. I don't think it would make those now with your typical 10% pullbacks. That would now bounce back up to new highs within weeks, which is kind of what you expect. But I do think, obviously that's what starts bear markets. And we actually did have quite a bit of excess speculation coming out of COVID, right? With NFTs and crypto to a degree and other things. And that's been washed out, actually. A lot of that excess speculation. I agree. There's not a whole lot of excess speculation now. Not even in, like, say, in Bitcoin. Even there doesn't seem. There's been a nice little pullback correction in Bitcoin here lately. So I don't even see excess speculation there. But what I think will be different from this particular macro environment in terms of a sign of exhaustion is that excess speculation, is the fact that affordability is. I think that is our speculation. Like, it's so damn expensive to buy anything. And I know, like, our earnings are up, but people, like, from a sentiment standpoint, I don't think we care how much our earnings has gone up in the last year or two. What we care about is how much my mortgage payment would be if I'm buying a new home, how much it costs to buy a car, whether it's a new or a used car these days, how much it costs to go out to eat, or traditionally, you could go to the store and buy groceries and eat for a lot cheaper, but you can't do that these days. So that, I think that is a unique macro situation now that we didn't have in 2007, that we didn't really have in 1999. We haven't had for quite a while, where, like, that's not a typical sign of a late cycle adjustment. So I think we can substitute excess speculation for this insane unaffordability that we're seeing across the board in so many different assets.
That's interesting, because I try to make that point quite a bit too, because particularly in the gold market, traded between 1,800 and 2,000 for several years, and now all of a sudden it seems like the new market is 2,300 and 2,500. And to me, and I'm going to make a point here that jives with yours. To me, that was just a re-evaluation of the dollar. The dollar is literally 70% of what it was just 3 years ago. So everything that's denominated in dollars must make that adjustment higher. And you can bring that to the stock market too. Like these stocks, and it's a future earnings stream, and some of those earnings are great. And you then, that's what happens when you devalue a currency that you had. So that's just wanted to get that point in. Bobby?
Yeah, I just want to put, I don't even remember how I ended up following this guy on X. I'm assuming it's a guy, Stocks Network. I don't remember following him, but he just said NVIDIA is using the Democratic policymakers for stock promotion. The story is no longer about fundamentals. It's greed. I mean, it's right here. So I think it's funny. It's like, and right under that, he has Nancy Pelosi started the stock promotion of NVIDIA.
That's why I bought it in the first place. That's why I got in the trade. It was kind of a lark. It was a lark, and I held it for almost a year because of Nancy Pelosi. Yeah,
these are strong accusations. NVIDIA supported her by dropping news and stock upgrades. But I don't even know why I brought that up. That's all.
I like a good conspiracy. I'm just not on board. Yeah.
Yeah, I mean, we've seen that. We saw that in 2000, like JDS, Uniphase, Qualcomm, like there's their stocks.
Another one.
We've seen these. We've seen these before, and there's a little difference this go around because NVIDIA does have earnings associated with it, where a lot of those companies didn't. The tech, at least the internet companies did, but the internet build out companies that were doing so well at the internet, they did have sales and earnings. It was just all pulled forward, and so now the question is, how much has NVIDIA pulled forward, and stocks like NVIDIA, from the next few years, right? If we haven't pulled forward enough, then the market will just keep going higher. But ultimately, if we pulled forward too much, then we see what happened in 2001 and 2002.
So what's your prediction on earnings, and just in a general sense as we wind down here? Do you think they're going to be strong, weak, jumped over a lowered bar? What do you think?
Yeah, I think there would be a pretty decent earnings, especially in those tech names. I think from the last earnings cycle, a lot of these names. I was just doing this in my class today. I teach on my website. We looked at a lot of their returns from the last earnings result. Even some of the stocks that dropped initially on their earnings release, they've been rising almost immediately since. And so, I mean, we're looking at 20, 30% returns in a lot of these big names since the last earnings release. So, I mean, I do believe that there'll be pretty strong earnings, enough to keep us from like tanking over the next so many weeks or so. But I think the upward potential, like if you're going to be buying a lot of these stocks on the earnings release thinking, oh, I can get a good 10, 20, 15% return out of it, I don't think that the odds of that happening are much lower because of the 20 to 30% returns we've already had going into the releases. So I wouldn't be too aggressive on like directional plays on earnings releases this cycle. But you definitely can take. I mean, I was also looking at the implied volatility for a lot of these big names, which generally speaking, large caps individuals should be higher than the S&Ps because of one stock versus 500. But some of these implied volatilities for these mega cap names are more than double or 5 times more than what S&P's implied volatility is. So I wouldn't take advantage of directional trades based off of that, but non-directional and taking advantage of that volatility coming back out after the earnings release, I definitely think there's some good opportunities there.
By the way, that's selling a straddle, selling a strangle. We can walk you through how to do that if any of us you want to DM us. If when tech has earnings and the first couple big tech names post decent earnings, stock pops and then reverses. If the pattern exists, how many stocks do you have to see that in before you think, oh shit, we're too bulled up? This is a big signal.
Yeah, the big ones. I would say like, at least one of the big 3 and then a couple of the others in the Max 7. But one of and we saw that in I can't remember. There was a year where Amazon just like a year or two ago where we saw that big pop up where Amazon gapped up. I think Apple gapped up as well on the same day, if I remember correctly. And then they dropped throughout the day. And we had already been pretty bullish going into it. If we saw something like that again among a handful of those names where they pop, but then they drop throughout the day of the earnings release, that will be a good sign to take advantage of. Looking for a pullback at least.
That's interesting. And I agree. By the way,
before we go, Jimmy, I'm sorry. Do you guys think retail matters? And the reason I bring that up is because consumers, large commercial debt, so credit cards and other revolving loans, highest level in history, but that's no big deal. That's been going up basically forever, right? Their delinquencies are rising on their credit cards. Their debt spending as a percentage of disposable income. It's not at a recent high. That happened in October of 2022, but it's approaching that recent high again. Obviously, the wage growth that happened over the past 6-8 months took care of that, but now it's going in the wrong direction again. Does the consumer, is that the only cure for inflation? Jimmy, I'm asking you too. Is that the consumers actually just stop spending because they haven't yet?
Yeah, I think that's going to be one. I believe that the dark clouds are gathering, and I think I'm further along in that belief than either of you two are, based on some of the conversations we've had. But I think that's going to be a big tell. And I think the lower half consumer is already struggling fairly mightily. And, the middle consumer, the middle high is carrying the load. And as soon as they start to crack, it could be a big deal. David?
Yeah, I agree. So that's the idea of money velocity, right? Money velocity starts dropping because the money stops exchanging hands. Right now, that doesn't impact NVIDIA directly. It won't impact some of these mega cap names directly, but eventually, the smaller. We're already seeing it. Like we're already seeing Visa and MasterCard, right? We're already seeing in some of these smaller businesses that are more impacted directly by consumer demand, and eventually when these larger companies, which depend more upon corporate demand for capital spending, when that starts to dry up because they're not able to sell their products to the consumers, then it feeds up the chain. But it will impact, as we're seeing probably already in the Russell 2000, it will impact some of these smaller companies first before it feeds up the chain to the bigger ones.
David is a CMT, so I'm not sure this is the right form of the question, but Tim is one of our best. He's just a fan of our shows, so I want to ask it because he has another question. When does vol breach 20 again? 2025 or 2026? I don't think your analysis is about when, but maybe you can sort of narrow it down if you can.
Yeah, volatility is about as compressed as it can be. There was a CMT. Now his name escapes me off the top of my head. Who won a award for a paper he wrote about volatility tsunami. If he's listening right now, perchance he'd probably be dying. I can't remember his name off the top of my head. But Andrew Thrasher, that's his name.
Oh yeah,
Andrew
I know he is. Right. Okay.
Yeah. Andrew Thrasher wrote this great paper. You can't predict when volatility will jump. Will jump to 20, but you can. It's like a tornado or a tsunami. He used the word tsunami. But I use the term tornadoes. You can't predict when a tornado will actually develop and touch ground, but you can predict the environment that produces them. And the environment that produces a volatility jump up to 20 or higher would be this compression where the ranges of volatility just compress over time, as we're seeing right now, to really, really low levels. So at some point in time, that compression will just pop, right? That's how volatility does. It pops, and then it starts to compress to lower levels, but it takes time after that pop. And so I don't even know if it'll be 2025. I wouldn't be surprised if we breached 20 on the VIX by the end of this year. Now, whether it will stay above 20 is a different story, but I wouldn't be surprised if we got above 20 by the end of this year on any kind of pop that we see.
I would add to that, you buy puts when you can and when the sun is shining. Just you don't buy puts when everyone else is buying puts. And by the way, Bobby, this is going to make you crazy because this is Jeff Kilberg said this once on air. He said,
don't compliment Jeff.
It was fantastic. He said, my policy is this. When I see a VIX between 50 and 60, I buy S&Ps with both hands. And I was like, wow, that actually it would work because it means there's been a big ass washout, and that's it. Kilberg, if you're watching the show, I will never compliment again.
But volatility is so compressed that there will be a pop. There will be a pop. Whether it gets to 20 or 19 or 18, it's the same idea. There will be a pop some point in time. I think by the end of this year. I don't even think you have to wait to 2025 for that to happen.
Let's call it here. I got
to say this because Kilberg will kill us if we don't. He played football under Lou Holtz at Notre Dame.
Played with Notre Dame.
It's always got to be mentioned when you mention Kilberg.
By the way, David, tell the people where they can find you on Twitter real quick.
At David Settle 42 is my handle, or at Market Scholars is our corporate handle, and just online at www.marketscholars.com.
Excellent. This has been a great conversation. I really appreciate you being here. As always, your wealth of knowledge is amazing. And thank you people for being here too. Without you guys, we have nothing. This platform is nothing without the feedback we get from you guys, the DMs. Remember what Bobby and I are trying to do. We both were in mainstream media for a long time. We realized that you had to please the producers. You had to please the sponsors. Here we please Tradier because we love Tradier, but we don't have to please Tradier. We can say what we want and they support that. That's why we are here. Thank you guys. This has been Tradier, the Trader's Edge.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.